Open any news site, and there it is. Yields are climbing, the Fed is hiking, the bears are winning. Sounds like a secret language for people in expensive suits, right? Give me 5 minutes, and the next time someone mentions bonds or GDP, you'll nod with a very smart look on your face and actually know what it means. Let's start with a stock. A stock or a share is just a tiny piece of a company that you can own. Buy one share of Apple, and congratulations, you're technically part owner of Apple. If the company does well and grows, your little slice gets more valuable, and you could sell it for more than you paid. If it struggles, your slice can shrink. Now, dividends. When a company makes a profit, it has a choice. Reinvest that cash or share some of it with its owners. When it pays the owners, that payment is a dividend. Think of it as a small thank you check that lands in your account just for holding the stock, no extra work required. Next up, bonds. Here's the simplest way to keep them straight. A stock makes you an owner, a bond makes you a lender. When a government or a big company needs money, they don't always go to a bank. Instead, they borrow it from people like you by issuing a bond. In return, they promise two things: to pay you back the full amount on a set date and to pay you regular interest along the way. So a stock says, I own a piece of this. A bond says, I lent them money and they owe me. Bonds are usually steadier and safer than stocks, which also means the reward is usually smaller. Now the big one you hear about constantly, the interest rate. An interest rate is simply the price of borrowing money. Borrow $1 and you pay a little extra to use it. That extra is the interest. A country's central bank sets one key rate, and it quietly ripples through everything. Your mortgage, your car loan, your credit card, even the interest on your savings. When the central bank raises rates, borrowing gets expensive, so people and businesses spend less and things cool down. When it cuts rates, money gets cheap, borrowing jumps, and the economy speeds up. That's why one small announcement can move the entire market. Here's one you hear in every economic update: GDP, or gross domestic product. GDP is basically the total value of everything a country produces, all the goods and services added up over a set period, usually a quarter or a year. Think of it as the economy's report card, or its overall scoreboard. When GDP is growing, the country is making and selling more, and that's a sign of a healthy, expanding economy. When GDP is falling, the country is producing less, which, as you'll see in a minute, is exactly what economists watch to spot trouble. So when the news says the economy grew 2%, they're really talking about GDP. Here are two you'll hear in every market report: bull and bear. A bull market means prices are broadly rising and people feel optimistic. Picture a bull charging upward, full of confidence. A bear market is the opposite: prices falling for a while, fear in the air, everyone bracing for worse. Here's an easy way to remember it: a bull attacks by throwing its horns up, and a bear attacks by swiping its paws down. Up is bull, down is bear. So next time someone says we're in a bull market, you'll know they just mean the mood is green and rising. Now, an index. You constantly hear the market went up today, but the market is millions of different stocks moving at once. So instead of tracking all of them, we track a sample. An index is basically a curated basket of stocks used to measure how a whole group is doing. The most famous one, the S&P 500, follows 500 of the largest companies in the United States. If most of them rise, the index rises. So when someone says the market's up, they usually mean an index like this one climbed a quick snapshot of the whole crowd. Next, market cap, short for market capitalization. It's simply how much a company is worth on the stock market right now. The math is easy. Take the share price and multiply it by the total number of shares. So a company trading at $100 a share, with 1 billion shares out there, has a market cap of $100 billion. This is the real reason the news calls one company bigger than another. They're comparing market caps, not the number of employees or the size of the buildings. It's the market's price tag on the whole company. Last term, recession. A recession is when the economy shrinks instead of grows, and not just for one bad week, but for months. People spend less, so businesses earn less, so hiring slows, so people get nervous and spend even less. It feeds on itself. A common rule of thumb is 2 quarters in a row, that's 6 months, of the economy going backward. Here's the reassuring part. Economies naturally move in cycles, up and down, over and over. A recession isn't the end of the world. It's just the down part of that cycle before the next climb. And that's your financial news starter pack. Stocks, dividends, bonds, interest rates, inflation, bulls, bears, indexes, market cap, and recessions. 10 terms, and suddenly those intimidating headlines make a whole lot more sense. You've officially earned your nods knowingly at the news badge. Now over to you. Which important term did I leave out? Drop it in the comments. I actually read them, and the best suggestions will become the next video. And if this finally made finance click for you, you already know what that subscribe button is for.